Are you a smart trader?
Welcome everyone to Traders of the World, our interview show where we bring inspiring stories about the financial market and incredible guests. I am Matheus Massari and I am extremely excited to be here. With me, I have Flávio Lemos.
Hello, good morning, good afternoon, or good evening, wherever you may be around the world. I'm Professor Flávio Lemos, chairman of the Brazilian local chapter of the CMT Association, and also author of some investment books. And we are speaking English because we want this show to inspire new traders around the world. I hope you all like it and subscribe to our channel.
Great. I'm certain that we will have an amazing conversation with our guest. Speaking of our guest, he is the 2022 Charles Down Award winner. His passion for research resulted in being an award market technician, having received the Founders Award for Advanced in Active Investing Management and the CMT Association Charles Down Award for Outstanding Research in Technical Analysis for his paper, MACD-V, Volatility Normalized Momentum. The MACD-V has been recognized for study of momentum using a very popular technical analysis indicator, the moving average convergence divergence. Flávio, is he a CMT member?
Of course, he's a chartered market technician with more than 25 years of experience. He's also the founding chairman of the London chapter of the CMT Association. He began his trading career more than 20 years ago, and it changed his life forever as a quasi-systematic cross-asset proprietary futures trader. He's currently trading his own book and is active in all major liquid futures markets across all major asset classes as equity, interest rates, forex, commodities, while enjoying life with his family and the most amazing cat in the world called Greco by the beautiful coast of Southeast England. Alex, over the years, has built an extensive database of models and indicators that includes inputs from intermarket analysis, commitment of traders, sentiment, economic statistics, and thus developed a rules-based multiple time frame, multiple factor approach.
So let's dive in. He is the founder and CEO of S.M.A.R.T Trading Systems London, a firm focused on training, support, and development of institutional traders via a 15-step rules-based learning path of quantified technical and macro strategies. Please welcome Mr. Alex Spiroglou.
Thank you so much, both of you, Flávio and Matheus, for the introduction. You made me sound more important than I really am.
Not really.
Thank you.
Thank you so much for being here with us. Thank you so much for being here and sharing your experience.
So, Alex, tell us more about your beginning in your career. Where are you from? Where do you live now? And what did you study? How you got interest in technical analysis and trading?
Yeah, sure. That brings me back a lot of years. I this year I'll be 50 years old. I was born in Greece, in a beautiful city called Thessaloniki, which is in the north of Greece, right in the center of Macedonia. So I was born there, and from an early start, I was very interested in economics. My father was actually working for Bank of America, and as a child, I wanted to impress their father. I wanted to look up to him and basically follow in his footsteps. But I've always had an interest in economics. So after doing my GCEs, I went to City University in London, did a bachelor's in banking international finance, and right at the last year of my study in London, there was an elective course. At that time, that was back in 1996. There was an elective course called forecasting. Now, forecasting was taught by a professor, which I'm still very good friends with, called Roy Batchelor. Now, Roy Batchelor was an ex-futures trader in the pits in London, in life. So he was very aware of technical analysis, but in 1996, technical analysis was in the academic community, was considered a bit of a voodoo art. But he wanted to teach it because he was using it, and he saw how practical it was. So what he did is teach technical analysis at the beginning and end part of the course. He added a lot of econometrics, so he called it forecasting instead of outright technical analysis. So I took the elective course, and 1995, 96 was my first introduction to technical analysis, and I fell in love with it since then. So that was the first touch or introduction I had with technical analysis. And after that, I went to do my military service. Went home to do my military service, served as an officer for 2 years in the Greek army. And then I continued, went in the financial sector and started my studies in technical analysis. So that's the very brief version of how I started.
Nice. Great.
Of course, a lot more has happened since then, but I don't want to be boring you with all the details.
Yeah. So, have you worked at proprietary trading firms? Up from this, what did you learn to do and not to do there?
Yeah, I've worked for prop firms, futures prop firms in London. It was a very interesting experience, and I also met a lot of interesting characters. One of them was actually called, you probably have heard of him, Navinder Sarao, who was the flash crash guy, a gentleman from London who was accused of, through spoofing and other, well, allegedly, crashing the Dow. Well, Nav and I were working right next to each other. So I met a lot of interesting people, and it was an experience that taught me a lot because the traders there were like hunters. They basically ate what they killed. They were considered locals, and they were trading very fast, very big size. It was a very interesting environment because other than being a learning environment for me, and also helping me to hone in my trading skill, it was a very collegiate environment because the firm was always, its structure was very flat. The firm was called Futix, one of the bigger proprietary firms in England at that time. The structure was very flat, which means it was politics free, the trading floor. At its peak, we probably had more than probably 80 traders. So it was politics free. So that helped create an environment where people were helping each other. So you could learn a lot of things, even if, because of that environment sharing, you could learn a lot of things, even if your style was not compatible with someone else's. Because my style was technique specific. I was never market specific. But we had one part who were FTSE traders, others were bond traders, others were energy traders, others who were more like me, others who were a bit more systematic. But through talking, you could always learn new things. I mean, exchanging ideas.
In my book, I have a resume of the flash crash that you already mentioned. In the book, I have a little story about this flash crash, so everybody that has my book could read that. And Alex, have you known personally Gerald Appel, the creator of the original MACD?
No, unfortunately, no. I don't know Gerald Appel, although I would have liked to have known him and also to show him the work I did based on the work he did. And like they say, you're standing on the shoulders of giants. Yeah, unfortunately, I didn't get to meet him because when I published my work, he had already passed away. I did my work on the MACD, the MACD. I created the improved version in 2015. And I made it public in 2022, but he had passed away, I think, the previous year. So unfortunately, no. But through my association or work I have done for the CMP Association, then MTA as we call it, that was back in 2010 when I started, when I first became a member. I got to meet a lot of people who have managed to call good friends. And I having gone through your Flavio, your YouTube channel, I see we have a lot of mutual of friends. I mean, people who are truly friends, like my very, very good friend, Tom DeMark, top guy.
Incredible.
John Bollinger, Martin Prin, Linda Rashke.
David Geller.
Absolutely. Dave Keller, Tyler as well. I mean, there are so many people. I mean, I would really, I really don't want to mention any more names because I would be leaving people out. So great people.
Yeah, the CMTCC is an awesome place to make good friends, wonderful friends. I have friends since 2005. I'm a member since 2005, so I know everybody there for years, and they are very generous to be here on the show. So, how you came up with the idea to create MACD-V?
Yeah,
and
the
how
MACD.
to use it in winning trades.
Good idea. Well, basically, to tell you the truth, the MACD-V, I tell you the truth, I never intended to write a paper. Absolutely intention. What I wanted to do was create a tool that would fix the limitations of the current landscape of technical analysis momentum indicators. So I created it purely for my own use. So what I saw was that, okay, from the from the hundreds of momentum indicators, basically you can classify them in two categories if you create a taxonomy. The first one is range-bound indicators, so like the stochastics, the RSI, go 0 to 100. And then you've got boundless indicators, sort of like the MACD or rate of change and so on and so forth. But each category has its own limitations and its advantages. So, for example, the bounded indicators, 0 to 100, they have the advantage that since they are normalized, 0 to 100, they can compare across time and also across securities. The problem they have is because they are bounded, the readings they provide are not as representative of the current environment when you're going into high momentum environments. Because, for example, the for example, the S&P 500 may be rallying. Well, the indicator can only go up to 100, and then it stagnates while the market rises. On the other side, the boundless indicator don't have this issue. Actually, they can adapt because they are boundless. As long as the market rises, the indicators can rise as well. The problem is that they're not normalized. So the readings that, for example, the MACD, because it's an absolute price indicator, it's basically the difference between two moving averages. The readings it has are not comparable across time, especially if your market rises for a long time. The absolute price you will have corresponds to this time. It doesn't, you cannot compare it across time. Again, to cut a long story short, I wanted to find the best of two worlds, create an indicator which is on one hand boundless, but also normalized. So my idea was to take a boundless indicator like the MACD and then normalize it so it can have the advantages of the indicators such as the RSI. And hence came the MACD-V. So I created the MACD-V, and then I started creating a lot of techniques because it opened up a lot of opportunities, patterns, which were not available through the classic MACD. And for example, by normalizing and creating it, even in the simplest form, like overbought, oversold levels, fast, slow, these patterns are not possible with MACD. So I created a lot of patterns. I created a more advanced version than the one I presented in the paper, which I will be publishing very shortly. There is a lot of meat on the bone there. I mean, you can create a lot of advanced techniques with it. But at the very basic level of it, I've got the 7 ranges: the rally range, the risk range, rebounding range, retracing range, reversing range, and also the when the market is ranging. And that's also a very innovative technique, how to find, because as technicians, we should be distinguishing between when the market is rallying or ranging. And it's very important to do so because around 80% of the time, 75% of the time, markets are ranging. And through the MACD view, you can do that in a quantitative and real-time basis.
I personally use your indicator. I have programmed it here in my software and used for Brazilian equities. And I saw you use it with trend regime filter created by Chuck Ducasse.
Absolutely.
And what's the best configuration of MACD-V ranges together with trend regime filter? Do you think buying a stage 2 with MACD-V bigger than 0, or there's something you have probably you have done a lot of research on that?
Yes, absolutely.
And for selling using stage 5 with the deposit.
Absolutely. Yes, basically what I try to do, do a lot of content. I present a lot of research in the paper, and it was inspired by the work of a gentleman, also a friend who's passed away, Andrew Cardwell. So basically what I try to do is find a range, trend-specific overbought and oversold levels, because the basic observation was, again, based on Andy's work, that overbought and oversold is a relative term based on the trend. So if a market is uptrending, it will not dip as down as much as it would when it is in a downtrend. So bull markets, the troughs for the indicator, the bottoms, will be at a higher level than, comparatively speaking, when you're talking in a bear market. So in order to define bull and bear markets, I use a very simple model based on Chuck Ducasse, the 200 and the 50-day moving average. And based on the configuration of this trend, I try to segregate the market in regimes and say, for example, when the market is over the 200 and the 50-day moving average, what is the lowest value the indicator can have while retaining this regime? And it was quite insightful when I started, noticing that, because I could, say, okay, if the market is made assumptions, and based on these assumptions, I created strategies. For example, I said, if the market is this regime, that's statistically the lowest value the indicator can have. So based on this observation, I started looking for positions around these values. Now, that doesn't mean that the market cannot go lower, but what it says that if the market stays in that, that's probably that's the safest bet you can have. If it does have this regime, or for example, if it is over the 200-day moving average, is a very deep correction. If the market is to retain the uptrend, what is the lowest value the indicator can have? So based on this, I created various patterns and setups. They're not infallible, but they're very useful because they've been quantified.
I saw you use different factors in your model as business cycles, sentiment, seasonality, volatility, MACD, V, and so on. So please show us, how does the SMART trader development system works? Could you give us some examples too?
Absolutely. Let me share a chart here. Okay, got it. So basically what I have created a roadmap. I don't know if you can see my cursor as well moving.
Yeah, we can.
All right, thank you. All right, so okay, let's start from the first principles, the foundation of what this thing is. There are two basic principles that the whole thing resides on. The first principle is that there are multiple time frames in the market, and the operating time frames that I work on is the monthly, the weekly, and the daily chart. The second founding principle that based upon which I created this is that each time frame has its own return drivers, and that means there are different factors affecting the monthly chart, different factors affecting the weekly, and different factors affecting the daily. So that's why I created what is called the multiple MTMF approach, multiple timeframes, multiple factors, in which I try to combine technicals and fundamentals. So I keep my fundamental analysis on the monthly and weekly chart, and my technicals on the daily chart. Now that means that that doesn't mean that you can't do technical analysis on the monthly and the weekly. Of course you can, but the thing is, I'm more interested in these time frames as setups. So on the monthly chart, the biggest factor I look at is the business cycle, where I usually see through various economic statistics. I've created models that work on, for example, like productivity, inflation, unemployment, and so on and so forth. So I try to gauge where we are in the business cycle on the monthly chart. Then I turn onto the weekly chart, and through that I use commitment of traders report, sentiment, seasonality, and also intermarket analysis. So these are the factors I check on the weekly chart, and when I look at these factors, I try to see if the market is bullish or bearish using, again, systems and models. And if I have the market being bullish or bearish or neutral, maybe I don't have an opinion on the market, on a particular, using this multiple time frame, multiple factor approach, because basically I don't want to be looking the market just through technicals, or if I use fundamentals, just one factor, then I switch on the daily chart and then look for a setup to see it from there. So the factors I look at is the trend. I use a basic 8-stage model to see the trend. Then I look at momentum, where the MACD comes in. Then I look at volatility, because as I created a special indicator, volatility valuation, got inspired by John Bollinger, because he once told me that high volatilities low volatilities where markets where trends are born, and high volatilities where they go to die. So I thought about that, and I created my own version of a volatility valuation indicator, which holds me when there are extremes in volatility, because people say that volatility is a mean reverting. Actually, it's extreme seeking. And also have a relative ranker. Basic relative ranker is a way to rank markets according to the strength they have. So comparatively speaking, see which is the strongest market. For example, now it's Cocoa and Bitcoin are the strongest, most bullish markets. And the reason you want to be doing that, because if you're going to be going long, ceteris paribus, all things being equal, you're going to be going long the strongest markets. So these are business cycles, commitments, trade report, sentiment, seasonality, intermarkets are my setups. Then I go to the daily chart, the technicals. And how do we now, switching from analysis to actual trading or a system? In order to create a strategy, I have the 4S framework, basically 4 steps: setup, signal, stop. Actually, it should be stop here. Sorry, guys. Stop and size. They are in the reverse order. Now, a setup basically is the condition that tells me should I be long or short the market, and also allows me which strategy to trade. So the setup is basically all these factors put together. So I say the market should be bullish or bearish. Signal, of course, as we all know, is where we actually get in. Stop is where to get out. I have 4 types of stops I use, and then also size, which is the position size. Now, this framework, as I mentioned, is multiple time frame, multiple factor, but it's also semi-systematic. Why is it semi-systematic? Because some parts of it are fully systematic, and some parts of it are discretionary, rules-based by discretionary. So the setup is discretionary, rules-based and discretionary, which means, yes, I do see the various factors through models, but I want to be keeping an element of personal evaluation, if you will, if the market is bullish or bearish. The signal is completely systematic, which means once I have decided the market is bullish or bearish, I turn on a system I have which just provides entries, but I don't work on it on its own. There has to be context to it. So then I use the stops, which are also systematic, And then the size is semi-systematic. I mean, there are rules about it, but it's also a function of how bullish I feel in the market. So if I feel very bullish, I'll take a 2% percent size of my account on a market. If I don't feel very strongly about a market, or if it's a bit counter trend, I go to 0.5. So anything in between. So I hope this is the framework I do my decision making. I don't know if that makes sense to you.
So you do look fundamentals in a year basis, a monthly basis, and a weekly basis, you said, and you use intermarket analysis. So I have a difficult question for you now. What do you think about our environment where gold goes up, commodity goes up, the dollar goes up, and the stocks goes up? Is something is out of place? Do you think? How do you feel this environment?
Well, yeah, that's a good question. Well, basically, the argument here is, why does dollar go with gold? Because they should be going opposite. Now,
Yeah.
if you go back in history, you will find that there have been extended periods where the two trended together, and it has to do with inflation and interest rates. In general, by and large, there is an environment where they usually go opposite, but not necessarily. So the correlations do fluctuate. So for the here and now, although I have been long gold, I'm currently a bit skeptical on how much the rally will extend going from here. So I wouldn't be surprised if the correlation changes going forward, the positive correlation.
It's like a flight to safety because of all these wars going on, and maybe another one with Israel versus Iran, and something like this. A lot of people, this kind of flight for safety.
Yeah, look, yes, to tell you the truth, all this, what you said is very valid, but from my point of view, I usually try to stay away from doing what I call sometimes scenario-based investing, because I'm not good at it. So what I try to do is look at the fundamentals. One of what I call fundamentals is the commitment of traders report. And as soon as I started seeing heavy commercial buying, I knew that gold would rally, although I did not have an immediate story behind it. I mean, it's something that I could always use with the benefit of hindsight to resonate why gold would rally, but I tried to see it from that point of view. So I saw the commitment of trader report, the commercial was heavy buying, but there was also sentiment extremes, there was good seasonals. So there were a lot of factors pointing towards a gold rally, also interest rate differentials. And so I try to focus on things that I could quantify and could control rather than a narrative. Now, that doesn't mean that the narrative is wrong. It's just that I'm not very good at building positions based on narratives. I'm just, some people can do that, and I don't have a talent for doing that.
Okay. So, Alex, as always here at the show, I need to ask you, what was your worst trade and what have you learned with it?
I've had quite a few, and for some reason, the worst trades I've had are more memorable than the good ones. I tell you the worst one I've had. There are two actually that have stuck out.
And Alex, we have asked this to told the mark too. So
yeah. No, it's a good. I mean, to tell you the truth. Well, there is a before I answer the question, there is a psychological study that says that pain is a more memorable experience than pleasure. I think people have quantified that 3 or 4 times. So maybe that explains why I remember it more. The first one was a DAX. When I got long DAX, it was during a correction it was having. And I had the stupid idea of canceling my stop, because I got the position in, it started falling. I was pretty sure the market was rallying, so I canceled my position. I canceled my stop. It went further my way, against me. up until the expression we used at that time, I puked out and I closed out the position. The market continued falling for just a little while and then started rallying. So I literally almost sold at the very got stopped out at the very bottom, but it was a heavy loss. And the other one, I had the natural gas. It was pretty similar scenario again. But although that one, I was also probably had a very big position size. So these are the two memorable losses I had, which was a lesson of sticking with the plan, sticking with the rules, discipline. Don't trade your opinion. Don't trust opinions, especially your own. Systems, plans, that's what really matters. And so basically I broke my risk management.
Nice.
Natural gas and silver are killers.
Yes, they are.
They are terrible.
Yes, they are. And to tell you the truth, the ironic part, to tell you, Flavio and Mateus, the ironic part was, so if the market, to tell you the truth, if the market continued falling after I got stopped out, there was some kind of a feeling of consolation. Okay, it fell, but ironically it started rallying after I had closed out my position, so that made me feel like even twice as an idiot.
That's terrible.
yeah. So
Nice.
I was right, and I managed to lose money on it.
And so this go on with the next question, which was if you do recommend that investors and traders use the risk management.
Risk management? No, they should throw the dice. To tell you the truth, longevity in this game is a matter of risk management, because of course we all need an edge to take advantage of in the market, but without a risk management framework, we will not have endurance. We will not last in this game, because all it takes is one or two bad trades, and we've seen that. For example, the what I've just mentioned about the bad trade I had on natural gas and DAX. If I was stupid enough to keep that a further time, would have wiped up my account. So longevity is, risk management is what will keep you in the game.
Nice. So do you use volume as a timing tool?
I haven't been smart enough to figure out anything to do with volume. I use open interest a lot, the commitment of traders report, but no, unfortunately, no. If I haven't found anything meaningful now. And I'm very careful to say that I haven't found something meaningful, but that doesn't mean that it is not meaningful. Maybe someone else has managed to work out something, but I haven't done so.
Alex, why is it important to keep practicing, backtesting, and continue to learn about the market?
Flavio, you've touched a lot of important points. First of all, backtesting, which is the verification of ideas we have, because we get a lot of, I think this pattern works, but unless we test it, it might just reside in our own imagination. So the first thing, backtesting is very, very important. And it also gives you not just an idea if something works, but it also gives you a very good gauge of what's the best case scenario you can have. Because when you test a system and then you launch it into the market, it goes live, there is degradation. So it will perform worse than the backtest. By and large, this is what usually happens. So it gives you also an idea of how much, what's the best it can do. So backtesting is very important. So practicing is also very important, because if you want to be taking that methodology in a live market environment, you'll find the difference between your trading plan and your trading journal is your psychology. So, and the only way to find to practice that is within a safe environment. That's why I always say, do not launch a strategy, whether it's fully systematic or on a discretionary basis, on a real-time basis with live money. do it very safely on a demo account, if you will. So you can work on your execution skills, both from a psychological point of view and also things that will not be that present on the back test. So a lot of people say sometimes that trading on a demo account is not the real thing, but my reply to that is you get 80% of the experience with 0% of the risk. And it's extremely important. You can do the same thing in medical school when people operate on cadavers, or you can see it the same thing with the military when people train with live ammo. Obviously, they have to train before the actual fight. With flight pilots, and there are a lot of professions who do this kind of training.
So, do you think traders are made or born? And what are the main myths in trading?
Made or born? I've been battling this question for a long time. That's a good question. I think traders are made. Good traders are born. So I think a lot of people can learn to trade, but the Paul Tudor Jones and the Steve Cowens, they were made. Sorry, they were born. And but both of these good traders and exceptional traders have one thing in common: they have worked. Just because someone is born with a natural talent, that doesn't mean the talent itself will make them into something great. So, for example, even it's outside of trading, for example, in sports, like take basketball, Michael Jordan, he would not become Michael Jordan, the Michael, with the music behind him, if he wasn't working that much. Yeah, of course, he was an unbelievable talent, like an athlete that you get one every 50 years, like Usain Bolt or Pele.
Mm-hmm.
But I'm sure they had to work.
Yeah.
And what are the main myths in trading?
The main myths in trading. Main myths in trading is that you can take an account which is $10,000 and you can make it into 1 million within 1 month. While we all know it takes at least, you can do it in a week. So that's one of the main myths. It's it's the hardest way to make an easy living. It takes work. I mean, it literally takes work, and it's a tool that teaches. I mean, you can discover a lot of things about yourself. I think that's one of the biggest myths of trading. There are a lot of misunderstandings, I think, but I think that's the biggest myth.
And could you suggest some good books to learn how to trade?
Good books to learn how to trade. There are a lot of good books, and I would suggest to people, depending on where they are in the trader development journey. I forgot to mention that the Smart Trader system is a trader development system that has 5 levels to it. So coming back to your question, depending on where you are in these 5 levels, I would recommend different books. So if people are on the first stage, I would recommend to them books that relate to getting an understanding of about trading in general. The first stage, basically the 5 stages of trader development, what I call the SMART system. The first is the self-knowledge. So for the group in the first stage, the self-knowledge stage, I would talk to them about trading in general, how to create a business plan, what are the requirements in terms of capital, in terms of time, in terms of education, very generic. So the second stage of trade development, the SMART, is M for knowledge. For them, I would ask them books towards the learning about a bit about fundamentals, a bit the technicals, get a general understanding of how markets work, how they go from point A to point B. in the third stage, which is the trading plan, the A in the SMART system, then you go into the more technical parts. How do you take these inputs, the fundamentals and the technicals, and create them into a system? Again, there are a lot of good books on how to create a trading plan or trading system. The fourth stage, which is the R in the SMART acronym, repeat and review. Then you go into psychology, because a lot of people lose, but they think they lose because of psychology, but I think most of them lose because they don't have a trading plan or a trading system. If you have that and you continue losing, then obviously it's your execution. So if you've got that part settled, then you go into books into trading psychology. And again, there are a lot of good books. For example, like Steve Ward has a lot of good books on that. And then the final book is, how to make a business out of your trading, the T for become a trader, a track record. And again, how to build a business, how to go, if you want to build a fund, or how to create a database of strategies, because no strategy lives forever. So I think it depends on where you are in your stage of trader development.
Nice. And where our audience could follow your work on social media?
I am most active I would say on LinkedIn, so they can contact me at Alex Spiroglou on LinkedIn. I also have a Twitter account, Facebook account, again, Alex Spiroglou, and also my YouTube channel, which I'll try to be engaging a bit, making it a bit more active. Primarily, you'll find me on LinkedIn and YouTube, but feel free to contact me at my website, which is to be launched soon, www.alexspiroglou.com. It's under construction right now. Send me an email, and I'll be more than happy to answer any questions from the little things I know about markets.
Nice. Everything is going to be on the description.
Thank you.
Alex is a very generous, Alex, and very great person. I saw him at the internet discussing his method with other analysts, and was great. And he was very generous to share with this experience with the world. So thank you very much for that. And what's your final advice would you give to younger traders, Alex?
There are a lot of things I would give, depending on where people are on this 5-stage trader development framework. But in general, I would say that this job is for marathon runners. It's not for sprinters. But it is a very good path to take if you want to be having an active design of your lifestyle. And also, it is a very good tool to search inside you, because when you make mistakes, in order to see where my mistakes came from, unless because I didn't want to blame others, like my brokers or the market, I had to look inside myself. So it's a good tool for self-awareness as well. So it's a good journey. It's a lifelong journey, but it's a marathon, not a sprint.
So we come to an end of this amazing interview with Alex. We want to thank you all, our viewers, for joining us on this journey.
We also want to say thank you very much. Na verdade, muito obrigado, porque ele entende português, for sharing his stories and remarkable realization with us. We hope that his efforts and dedication inspire traders around the world. So, Alex, have an ouzo for me and a beer, like as you are in England, and have a good Friday.
Thank you so much. Thank you so much. Now I have to leave and feed my cat because he's getting a bit restless. And a very big thank you to both of you, and all the audience in Brazil. You have a beautiful country, which I would really love to visit, and visit the chapters there as well. And I'm sure I would meet good people, nice people, lovely food. And I really do hope our paths will cross in the near future and meet you in person as well.
Okay. I probably will go to the CMT summit next year or something like this.
Absolutely. I'll be looking forward with
Oh, please show your cat for us. Could
Show
you show
my
it?
I'll just keep Greco. Let me see if he comes back. He's a lovely cat. I mean, Isha would have known because he's so rich. Actually, he came right on my shoulder. Was like, squeeze him out of the picture. If I knew, I would have come. Perhaps next time if he comes. Thank you so much.
Okay, Alex. Thank you very much.
People. Thank you.
Have a nice weekend. Bye
You
bye.
too. God bless.